Today we are looking at the rating of bonds, or we call it credit rating or debt rating. We have seen in previous session about various types of bond risk, which are the controllable and uncontrollable risk that we have looked at, which include interest rate risk, inflation risk. Then we have seen foreign exchange risk, and then we looked at default risk. There's a major controllable risk. We have seen various types of risk, and today we look at how the bonds are being rated by different credit rating companies, credit rating agencies. When we look at 2008, there was a major crisis in US. We call it as the major financial crisis in US, which did not affect our Indian economy at that point of time in 2008 and 2009. We call it as the subprime crisis. Subprime crisis. The subprime crisis, the major factor for that subprime crisis was the credit rating. What happened was the bank gave loans to home builders, and then whoever wants to build houses, they can get loan from the bank. All those loans are being rated. All those loans will have to be rated by the different agencies, different different credit rating agencies. So without looking at the credit worthiness of the borrower, the loans were being given. The loans were being given without looking at the credit worthiness of the borrower. So what happened was, at one point of time, the borrowers, the house owners, could not repay the loan amount, and it got accumulated over the years. And then so many banks, including major investment banks, got collapsed in 2008 and 9. But that particular point of time, our Indian economy was very safe because we had a lot of precautionary measures whenever we provide loans to, whether it is a retail lending or when it is the institutional lending, or we call it as the corporate lending. So whether it is a corporate lending or retail lending, there was a lot of precautions were taken. But today also a lot of precautions are being taken to prevent all this, because the major factor in bank lending is non-performing assets. The loans which could not be collected from the borrower. Then at one point of time they could not repay the loans. It becomes the non-performing asset. So the major factor for that subprime crisis was the credit rating, the role of credit rating agencies in providing loans, because these credit rating agencies need to provide the proper rating, proper symbol for all these loans. But they just provide the credit worthy. They certify that these borrowers can give back their money. But one point of time, they could not give back their money. So the major factor for that particular crisis was the poor credit rating agencies' performance. They could not perform it well. So the credit rating, what we mean here is, it's an opinion. It's an opinion of the rating agency on a relative ability and willingness of the issuer of debt instrument to meet its debt service obligation as and when they arise. So rating is usually expressed in alphabetical or alphanumerical symbols. Always they say A++, B++, all that. So these credit rating doesn't mean that they rate companies. They don't rate companies. They rate the individual debt securities. When the companies provide debentures, when the companies provide loans, and when the companies issue bonds, when the companies issue debentures, what is the credit worthiness of that particular company to pay back its principal payment and interest? How far the company can pay its principal repayment and the interest payment. So predominantly credit rating does not relate to price risk. It doesn't assess the price risk. It assesses the default risk of a company. It assesses the default risk of a company. So we have seen last session default risk. Default risk refers to on the part of a company how far the company can repay its principal payment and interest payment. The company can pay its principal repayment and the interest payment. That means the default risk is zero. So in case of government-owned companies or the case of government, the default risk may be zero. We cannot say always it is zero. Some government has failed to pay its debt. Okay, so we cannot always say, that's what we call it as a sovereign debt. We cannot say sovereign debt. So this sovereign debt, sovereign risk is always, we cannot say it is zero. Some government, including Greece, Poland, they have failed, Italy, they have failed to pay its debt. But predominantly, the government-owned companies or the state government, central government issued bonds, the default risk is zero. But corporate bonds, we cannot say the default risk is always zero. There is a default risk. So the credit rating agencies play a pivotal role in assessing the ability of a company to pay its principal payment and interest payment. So it's an opinion. It is not a rating of the entire company. It's a rating of or is assessing of only the debt instruments, or we call it as a debentures, or it's a bonds. So it's an opinion regarding the timely repayment of principal amount and interest. So it is expressed by assigning symbols. So we say A double plus or A plus, A triple plus. Okay. So that provides, that gives an indication. That gives an indication to the lender or to the public whether the company can pay its principal amount or interest. So the rating reflects the default risk. As it was mentioned, the rating reflects default risk only. Default risk only. Not the price risk. It doesn't relate with the price risk because price in relation to the yield. So there is no, they cannot guarantee the price. That depends on the yield. The yield increases, the price falls. So the yield and price are inversely related. So we cannot assess the price of a particular company, the price of particular bonds or price of particular debentures. So it rating reflects only the default risk, not the price risk associated with the changes in the level of or shape of the yield curve. So it is important to emphasize that credit ratings are not recommendation to invest. So the moment you get A triple plus bonds, it is not that you should go for investing it. That is the individual to decide. The individual you have to decide whether you are going for A triple plus bonds or A double plus bond. So it is not a recommendation to invest. So it is just an opinion. That's what we need to be very clear. It's an opinion of a credit rating agency of a particular company with regard to default risk. It is just an opinion. So it is not a recommendation. The moment the debt rated A double plus or A triple plus rated bonds is coming out, it doesn't mean that all should go for investing it. So it is just an opinion. So how it is, the credit rating, it is just an opinion or it reflects about the default risk of a particular company. Whether the company can pay its principal amount or interest payment. So any clarification regarding debt rating, the meaning of debt rating or credit rating. Okay, so we say all the bonds are rated, all the corporate bonds are rated, provided we'll look at the symbol, the different symbols we have, A triple plus, A double plus, A plus, B triple plus. So like this, there are a lot of symbols we have. So each symbol reflects certain meaning that we look at. Okay. So any doubts regarding what is called debt rating? So it is not the assessment of a company. It is not the assessment of a company. It is an assessment of a particular debt regarding the default risk. whether the company can pay its principal amount and interest thereon. So what are the key areas they look at when they provide A triple plus, when the credit rating agencies provide these A double plus or A triple plus? What are the key areas they look into? They look into the business risk of a company. They look at the how far the company it's operating, their characteristics, industry characteristics. They look at the market share. They look at the marketing network, distribution system, technological aspects. All that they look at. They look at the business risk, and they look at the financial risk. They look at the capital structure of a company, how far the company is levered, high levered company or low levered company. High levered company means the company is employing more debt. The low levered company means the company employs more equity. Okay, so they assess the financial risk of a company. They look at the financial stability, and they look at capital structure and cash flow adequacy and profitability of a company. And then they look at the management evaluation, which includes the background of the particular company and the history of the company, and they look at the philosophy and the organization structure of a company. And then they look at the overall business environment analysis. They look at the industry, they look at the economic outlook, they look at the tax system of a particular country. So based on which the company is being rated. And sometimes you look at the country as a whole, it's being rated. You look at S&P's rating our Indian economy as a B++. So the rating is very, very common. So it doesn't mean that the rating is applicable only for the company which is issuing the bonds, but the entire economy can be rated by a different credit rating agency. So how they looked at they look at these parameters. They look at the operations of a company. They look at the background of a company. They look at the financial ability or financial performance of a company, and then they give rating. So these are all the various credit rating agencies in India and abroad. The major credit rating agencies in US is S&P, Standard & Poor, which is one of the major credit rating agency in the world. S&P, Standard & Poor, which was established in 1860. And then we have Moody's. Moody's is another credit rating agency in the world, which was started in 1900. It is 1900 it was started. And then we have Fitch, another rating agency, 1930 it was started. And then we have four major credit rating agencies in our country. Four major credit rating agencies. One is CRISIL. CRISIL, the Credit Rating and Information Service of India Limited, CRISIL. And then we have ICRA. ICRA is another credit rating agency in our country. That is Investment Information and Credit Rating Agency of India Limited, ICRA. Then we have CARE, another credit rating agency. CARE is Credit Analysis and Research Limited. And then, which is not popular, Duff and Phelps. It is not a popular credit rating agency. The three major credit rating agencies in our country are CRISIL, ICRA, and CARE. CRISIL started in 1988 after probably look at US credit rating agency started in 1860, and we have started a credit rating agency in 1988 after 120 years. After 120 years, we have started the credit rating agency in our country. So it's a very nascent stage credit rating agency. It was set up by ICICI and UTI. UTI in 1988, and it rates debt instruments. Nearly most of the ratings, most of our debt ratings are coming from CRISIL. CRISIL predominantly rates debentures, fixed deposits, commercial papers, preference shares, and structured obligations. The rating process ensures the confidentiality. They don't leak out any information. Once a company decides to use rating, CRISIL is obliged to monitor the rating over the life of the debt instrument. ICRA was promoted by IFCI in 1991 after CRISIL, after 3 years. The factor that ICRA takes into account consideration rating depends on the nature of the borrowing entity. CARE, it was started in 1993. In October 1993, it was started, which was promoted by IDBI Bank. So there are three major credit rating agencies we have in our country. That is CRISIL, ICRA, and CARE. The major credit rating agency in the world is US, S&P, Moody's, and Fitch. And we usually look at in the newspaper Fitch rating, Moody's rating of the Indian economy as a whole, because they don't rate our debt instruments. They don't rate our debt instruments. They rate only the economy as a whole. The economy as a whole, or the world economy as a whole, they rate and they provide the information whether this particular industry is good for investment or not. So they provide a proper information to the companies, how far the country is growing, what is the country major characteristics. So all that the credit rating agency provide a proper information so that the foreign companies can come and invest in a domestic country. So we have these are all credit rating symbols that we have. Okay, these are all credit rating symbols that usually they provide. AAA bonds, or we call it the AAA debentures. So AAA means the highest safety. The highest safety. That means the principal amount and the interest payment is safe. So as it was discussed earlier, what is important is it rates the credit worthiness of a company. Credit worthiness of a company. The ability of a company to pay its principal amount and interest thereon. Okay, the ability is good. The ability is very good. They give AAA bonds. So AAA bond means higher safety. The timely payment of interest and principal, that is called AAA bonds. AA, a little lower. The high safety and timely payment of interest and principal. A means adequate safety of timely payment of interest and principal. Okay. A BBB offers a sufficient payment of interest and principal. BBB, little lower. BB is inadequate safety. B indicates a greater default. C indicates vulnerability to default. D indicates the debenture is in default. Okay, you are not supposed to buy D-rated bonds. So it is noted that the value symbol is reduced, say from AAA to AA. The safety of the timely payment of interest and principal is decreased. So, for example, it is reduced from AAA to AA. So, what does it mean? It means that the safety is reduced. While AAA indicates higher safety and timely repayment, D indicates actual default and expected default and maturity. So different symbols indicate different degrees of risk of repayment of principal and interest. Okay. So for example, yesterday last session we discussed about Yes Bank. Yes Bank additional A1 tier bonds. It's a perpetual bonds. As it was, as we have discussed in the session, the month of May, during the pandemic, the entire Yes Bank was in trouble, and the investors were in great trouble. So it was a AAA rated bonds. Even then, it got defaulted. Okay, so it doesn't. That's what we should be very clear. So it is not a recommendation to invest. At any point of time, it can get defaulted. So it is just an opinion of a particular company regarding the principal repayment and interest. So it is not the decision of a company. So by looking at AAA bond, that the individual has to decide whether to go for it or not. You cannot always, afterwards, you cannot sue the company. I mean, it was rated AAA rated bonds, then it got defaulted. Can the individual can sue the credit rating agency? Can the individual sue the credit rating agency? They cannot. They cannot sue the credit rating agency because it is just an opinion of the particular company, default risk. So it may get defaulted. So that's what we need to understand. So it is not a recommendation for the investor to invest. It's just opinion. So opinion may go wrong. That's what we need to understand. Opinion may go wrong. Okay. So any clarification, anybody? So far. Anybody? Any clarification? Anybody? Any doubt? Hello? Deepak? Any doubt?
No, sir.
Understood?
Yes, sir.
Okay. So, I mean, the moment you get AA rated bonds, or should we buy or we should not buy? It's up to us. That's what important. It's up to us to decide. No? Even, that's what I said, no? Even S Bank A1 tier bonds, it got defaulted. It got defaulted. It was a AAA rated bond. Okay? It happens. So we cannot say, and I bought AAA rated bonds, it got defaulted. We cannot say. Yeah. It's like when we buy a cigarette. It is given written very clearly. It is smoking is injurious to health. Correct? Even then, people are buying and smoking. So the warning is given. Okay? So it is not a warning here. It is just an opinion. Opinion of the credit rating agency about the ability of a company to repay its debt, repay its principal and interest. Okay. Moving.
Yes, sir.
Okay. Which is the oldest credit rating agency in the world? Oldest. Standard & Poor. Oldest. Okay, credit rating agency in the world. Okay. For example, NSE, National Stock Exchange, was established with the recommendation, with the support of S&P. Support of S&P. Okay. Sneha?
Yes, sir.
What are the three major credit rating agencies in our country?
The CRISIL, ICRA, K, sir.
CRISIL, ICRA, K. Okay.
Yes, sir.
Okay. So whenever you look at the bonds, you look at which credit. Is it a mandatory? All the debt instruments need to be rated. Mamta Shri. 3148. Is it a mandatory that every company debt instrument be rated? Should be rated? Mamta Shri?
Yes, sir.
Is it mandatory that all the company debt instruments should be rated? Or the company can come out for issuing debentures without rating symbol?
Sir, I think it is mandatory, sir.
I think. Okay. Durga Prasad,
Yes, sir.
is it mandatory on the part of a company to get it rated?
Yes, sir.
Yes, it is mandatory. It is mandatory for all the companies, whatever the company which is coming for issuing bonds or debentures, it should have a rating symbol. It should have a rating symbol ranging from AAA to D. AAA to D. Okay, so you should have a rating symbol. It can be rated by ICRA, or it can be rated by CARE, or it can be rated by CRISIL, but it should have a credit rating symbol. It's a must. It's a must. But whereas for shares, there is no rating. shares do not have a rating. Why? Hello? One minute. Who is saying? Deepak, yeah. Why shares not have a rating?
My guess is, first of all, there would be too much of fluctuation.
Okay.
And then the AC and NSE already classified them into top 100 to 50. So that category.
Okay. Anybody?
Sorry, sir.
Yeah. Riju. Yeah.
So already, sir, before like a company going for public, there are agencies, they have due diligence of the company. They check everything, audit everything. First thing is that. Second thing is that there's a SEBI, Securities Exchange Board of India, which if there's any discrepancy, they strictly take care of it. So that's why they don't have a strict rating. And moreover, sir, it's a public company, so a lot of scrutiny happens.
So it means that debentures and bonds are issued without a proper diligence, without proper scrutiny by SEBI.
No, sir. It does, but in terms of shares and all, more it happens.
Okay.
So, investors who invest in shares, they will be already a little more ready for this than the debentures.
That means they should not get rated.
No, sir. Debentures are like people who don't want to take more risk go for debentures. So, ratings will help them.
Okay. So here means people are assuming more risk, so they should not get rated. So whatever the money, get it lost. You invest. So those who want to lose money, go for investing in stocks. That's what you mean.
No, sir.
Okay.
Sir, what if the credit rating agencies manipulate the ratings during?
No. Let me finish this. Then I'll come to your point. Yeah, that's a very good point that you have raised. A very good point. Yeah. I'll come to that point.
I think the rating agencies actually rate the companies, not the shares, but the companies.
No. See, they don't rate companies. That's what we get very clear. Either CRISIL or S&P or the latest one, what is that, CARE. They don't rate companies. So why not shares are, yeah, tell me.
Sir, you said now that bonds and debentures, the credit rating agency, they see it's their opinion that whether it will go default and all. But the shares, they can't go default, right? You're just rating the company. You are the owner of the company. So how can you rate it? That's what my point is. You can't rate the share, right? You are the share.
Why you cannot rate the shares?
Because there are analysts, there are various analysts, technical and fundamental analysts, which sees the creditworthiness of the company. But you, as a shareholder, sir, I don't think, sir, credit rating agencies, they will rate a share based on that.
Okay.
Sir, I think it is because of there is compulsory repayment of interest and principal amount in debt securities.
Okay. Whereas here?
It is on our own risk, sir.
Oh, fantastic.
There will be no
Fantastic. What's your number?
140.
What's your name?
140.
What's your name? What's your name? Huh? Sandeep. Okay. Very good. So you are given 2 marks. Instead of 1 mark, 2 marks is given.
Thank you, sir.
Excellent answer. Okay, very good. Okay, so that is the point. That's the point that this one. Here in debt instrument, principal amount and she's there. I mean, our Raghavi is there. Raghavi is there. Hello? Raghavi? She's here, no? Part of Raghavi is there, no?
Yes, sir.
Yeah, please give him 2 marks, okay?
Yes, sir. Okay, sir.
Please give him 2 marks. Default risk. In case of shares, there is no question of default risk. Default risk prevails only for debentures or bonds. Default risk does not prevail for shares. Because the company need not pay its principal amount. The capital, whatever the shareholders are investing, it need not be paid back. Because it's perpetual in nature. Company is in perpetual in nature. When will the company pay back the share amount? When the company is closed. When will the company be closed? It's a perpetual in nature. Dividend payment, no mandatory on the part of a company. Though the company is earning profit. The company need not pay its dividend. Okay? So there is no default risk. There is no question of discussing default risk here. So debt rating assess only default risk. So rating for share is not required. Is that clear? Hello?
Yes, sir.
So rating is not required because default risk is not there. Because company is not paying back its principal amount, that is a share amount. For example, today, which company is in the IPO? Anybody? Yesterday, today and tomorrow, one important company, government-owned company has issued IPO.
Indian Railways.
Very good. Who is that?
Sir, Indian Railways.
Who is that?
Rijo, sir.
Rijo, 1 mark. Raghavi, please give 1 mark. Raghavi, please give 1 mark to Rijo. 1 mark to Rijo. It's a Railway Finance Corporation of India. It's a government-owned company. I mean, these are all disinvestment.
There's a rumor. Sir, there's a rumor LIC will also come.
LIC is coming. Yes. LIC, not a rumor. LIC is coming. It's not a rumor. LIC is coming. Yes, LIC is coming. This year itself, LIC is coming. LIC last year itself should have come because of the pandemic. They could not come out with. They got a government permission already. They got a government permission to get SEBI approval. All that's ready. They're waiting for a chance. Because all the government-owned companies cannot come one after the other. They're waiting and then they're coming. So today, 26 rupees per share. 26 rupees per share. Railway Finance Corporation. Because that's a company which provide funds to the Indian Railways for infrastructure. So they want money through disinvestment purpose. So the company is issuing shares. Okay. So that particular share, 25 rupees or 26 rupees, I think 575 shares you need to buy. Okay, minimum you have to buy. So that much money has been invested. Say for about 20,000 rupees invested as a shareholder. If I want to buy today, so I'm investing about 20,000 rupees. So when will this 20,000 rupees paid back? When the company is closed. When will the company IRFC is closed? It's forever. So there is no default risk on the part of a company. So there is no rating of shares. But shares are graded. Shares are not rated, but shares are graded. The grading is given between 1 and 5. Between 1 and 5, the grading is given. The grading of IRCF share is 4. That means 4 is relatively good. So it is when the grading is given, it's not a recommendation. It is just an opinion. It's just a recommendation, it's an opinion. Opinion about the particular company's profitability. So shares are graded but not rated. Whereas debt instruments, bonds and debentures are rated but not graded. There is no grading for bonds and debentures. There is no grading for bonds and debentures. There is only a rating. Okay. So shares are rated. Shares are rated, but shares are graded, and bonds and debentures are rated. So anything anybody want to ask? Anything? Okay. Now we are going for a little more in-depth study. Credit rating symbols. What are the functions of credit rating agency? You can just look at. Everything is there in LMS. It provides unbiased opinion. Let us talk about what Nandish was talking about. Nandish, what was your say?
Sir, what if the great agencies manipulate the rating? Because it happened during the 2008 recession in America, where lots of mortgage bonds were given to play rating and all.
Yeah, correct. That's a very big question before us. Credit rating agencies are rating other company bonds or debentures. Who will rate these credit rating agencies? Who will rate these credit rating agencies? Of course, the government itself. The government itself has to properly monitor the functions and the methodology what they follow, because everything comes under the central government. It comes under the Ministry of Finance. So the Ministry of Finance has to properly monitor these credit rating agencies, because anybody can play. The low rated bonds can be given high rated bonds can be given low rated because of nepotism and because of the political background. They can do that, but government need to have a proper monitoring mechanism. That's what Nandish was mentioning. Subprime crisis, when it happened 1990, 2008, the major background was the credit rating agency itself. The credit rating agency has given a high level rating. That's why the banks went in for investing it. So the fault is not with the borrower, the fault is with the credit rating agency itself. The credit rating agency did not rate these bonds properly. Credit rating agency did not rate these bonds properly. So the fault is with the credit rating agency, not with the borrower. That was the major finding we had at that point of time. Okay, so these credit rating agencies need to be properly monitored by the government itself. So it provides unbiased opinion, because they should not be influenced by any factors. They should provide an unbiased opinion, and they should provide a quality and dependable information. They should not provide a proper information in relation to default risk. They provide information at low cost. Credit rating agencies should not charge more amount for getting these bonds to be rated. It provides easy to understand information, because the symbol is being given, so easily we can understand that information. It provides a basis for investment, because the moment we look at AAA rated bonds, we can go for investment. There's a healthy discipline on corporate borrowers. That means higher credit rating to any credit rating investment enhances the corporate image, because the moment the company is issuing AAA rated bonds, that means the corporate image of the company is increasing, and it forms the public policy, because once the debt securities are rated professionally, it would be easier to formulate public policy guidelines as eligibility of securities to be included in the different kinds of institutional portfolio. So when you define your portfolio, easily it can be formulated. So it provides a lot of benefits to the investors. You can go for investing. It provides a lot of benefits to the issuer, the debt instrument, because the companies are getting benefited, and the financial intermediaries, especially the the brokers, banks, merchant banks, they get benefited, and other business counterparties, they enter into agreement, so they get benefited. Regulators get benefited. They come to know what are the companies issuing AAA rated bonds. The regulators get benefited. And the major limitation here is it is difficult to monitor all the companies. All the companies cannot be monitored, because we have in number of more than 9,000 plus companies. It cannot be properly monitored. And once a rating is given, it should be properly monitored. And difficult to assess the default risk. That's what I was mentioning here. The example also is given here. The CARE was rating this 81 bonds by Yes Bank. CARE was rating. CARE gave A plus rating when 81 bonds were issued by Yes Bank. Later, it downgraded the rating. Okay? So it got downgraded, but the information is not known to the investors. Okay? So very difficult to assess the default risk, and it is a time-consuming process. It involves a lot of cost on the part of a company to go for a rating. So these are all the important limitations and different benefits to different stakeholders in terms of issuer, in terms of investors, the companies, regulators, and middlemen. All get benefited from this rating. So, any clarification? Anybody want to ask? Thank you.